Sarah Borse in Quito, and in conjunction with NAIOD's REIT 2021 Investor Conference, I'm speaking today with Dan Stegemiller, Senior Banker at KeyBank. Dan, thanks for joining me today.
My pleasure.
What are some of the pandemic best practices and other observations regarding the commercial real estate industry that stand out to you?
I would say first, just looking at it on the backside of what we went through, I believe going into a pandemic or the disruption that occurred was the real estate industry and REITs in particular were extraordinarily well positioned for what happened and how they were able to navigate through it. I think about it in terms of when I started my career, if something like this would have happened in the late 1980s, the lack of technology, an unstructured REIT environment, not much public access to capital. I really credit the professional management teams, the adoption of state-of-the-art technology to allow people to be well coordinated and seamlessly coordinated. People were working from home, they weren't in the office, they were communicating very broadly and efficiently. And I really think that's two functions of both professional management and the technology that they adapted over the years and spent and invested in to position themselves for something like this. Separately, I think all the REITs came into this 2020 with very strong balance sheets, intact business plans. They were very well maintained with liquidity, laddered their maturities, low to modest leverage, and were able to both take the punch and react to it favorably and position, come out the backside of 2020 in as good a shape as anyone could have hoped, given the economic slowdown, the disruptions that occurred. As you reflect back on it one more time, is that, as an institution, we were also able to use very seasoned bankers integrated across our platform with mortgage banking, investment banking, syndications, and respond quickly to these clients as they were navigating their challenges. They needed help with altering their contracts and looking ahead to say, what is the best information available? And as a sector, as a universe, we are able to work pretty seamlessly, even with the disruption of working from home.
Looking across the various property sectors, are we seeing that some are more active than others? And if so, what's accounting for that difference?
Some sectors of real estate were actually enhanced by the pandemic. It accelerated long-term trends much more rapidly, I would say almost exponentially. And when I think about that, it would be those real estate companies that are focused on technology sectors, data centers, et cetera. The industrial logistics business was very well positioned and caught the wind of the acceleration of last mile logistics, while other sectors of the economy were essentially shut. More and more products movement and shipment went online, requiring demand for space. But then I would also say that areas of the net lease sector and most all forms of the residential sector remain very healthy and very strong coming out of Q2 and were well positioned, largely because it was clear that they had long-term demand drivers for leasing, leading to strong and improving cash flows, broad abundance of availability of debt from different sources within the market. On the opposite end of the scale, I would say that there's a couple of sectors that have huge question marks remaining around them. Obviously the mall sector, power center sector. But off of what was in a bad place before, but is clearly in a recovery mode, is hotels. And I would actually say some components of seniors housing is also demonstrating an element of stability and back to a recovery mode as they progress. So I would say on the spectrum, you have the people that were residential, net lease, industrial, technology types real estate really were not disrupted. If they were, it was only for a brief moment in time. And in between, you have grocery anchored, self-storage, suburban office, and what I would refer to as flex office, spaces that accommodate small businesses that may have some element of a warehouse associated with it. But broadly speaking, the differentiation is predictability of cash flows and continued demonstration of ongoing demand. leading to abundant debt available to those sectors to finance new activity, finance expansion, and or just refinance balance sheets with lower costs of capital.
Can you characterize the level of capital market activity that you're seeing across REITs and commercial real estate?
I would say functionally it's been improving since last summer. The Q2 of last year was a near shutdown in most activities, just the uncertainties around what companies' rent collections were going to be, the shutdown around people just being out of work basically for several weeks or months at a time. But as we moved into the summer, that was the first movement of new capital markets activities, somewhat by geography, but also just by sectors. And I would say that since that time, we've seen an expanding amount of capital market activities, particularly with just given the dramatically improving macro conditions that existed. Base interest rates fell dramatically as a result of Q2 last year, and they've remained low, and many people expect them to remain low. Central banks have been really accommodative, as well as most federal governments have put quite a bit of stimulus in the market, which leads to confidence that the economy will strengthen and continue to strengthen and strengthen rather quickly as people become vaccinated and return to work. That's led to dramatic amounts of debt refinancing, both in the bond market and the mortgage market, and we're starting to see clear signs of recovery in the syndicated bank market, which is an ample source of liquidity. And so you keep coming, you move from debt into the equity sphere. And late last year and early this year, we saw new types of capital being deployed by some sectors in recovery. We saw convertible note offerings being executed for the first time in certain hotel companies that really were efficient executions and sizable executions, which gave new promise to those companies. Certain amount of common equity is being raised, but it's been to very strong firms that have remained in growth mode throughout most of 2020. As we look across our platform, we see activity, mortgage banking, syndicated loan market, investment banking, and the prospect of that increasing continues to improve as we start to see a pickup in asset property trading activity. There's been a handful of large M&A transactions, and we expect to see additional M&A transactions for both strategic reasons and accretive reasons. So overall, the market is very quickly returning itself to a level of demonstrated stability and belief in a solid future, particularly given the performance of the REIT market through the pandemic and coming out of it with, like I said, professional management, excellent use of technology, and very, very strong balance sheets.
Dan, thanks for joining me today.
Thank you. It was a pleasure being here.
And for more news and information from REIT Week, be sure to visit NAREIT's website, REIT.com.